Many people are worried about the stock market and their assets as a result of recent events. But don't panic, in this video, we'll discuss how to safeguard your investments in the event of a stock market crash. Welcome to the Mezinance YouTube channel. In this video, we discuss the recent stock market collapse and how to safeguard your savings. Part 1. What is a stock market crash? A stock market crash refers to a sharp, swift, and unexpected decline in stock values. It frequently occurs in tandem with panic selling and a general decline in investor confidence in the stock market. Economic recessions, geopolitical unrest, and market speculation are just a few of the causes of stock market collapses. Part 2. Diversification. Diversifying your portfolio is one of the best strategies to safeguard your savings during a stock market crisis. To spread your risk, you should invest in a variety of stocks, bonds, and other assets. In this approach, the effect of a market or stock crash on your entire portfolio will be less severe. Let's imagine, for illustration purposes, that you decide to invest $10,000 in a single stock. You might lose a large chunk of your investment if the stock fails. The impact of any one stock's decline will be less severe if you diversify your investment and place your $2,000 among 5 other stocks. Part 3. Long-term financial planning. Adopting a long-term investing strategy is another option to safeguard your assets during a stock market crisis. The short-term volatility of the stock market is inherent, but historically, it has tended to rise over the long term. By concentrating on long-term investing, you may survive brief market downturns and ultimately come out ahead. Consider making a $10,000 stock market investment in January 2000. You would have suffered financial losses if you had liquidated your investments in December 2000. Despite the ups and downs of the stock market, if you hung onto your investments for 20 years, they would have gained in value. Part 4. Dollar cost averaging. Utilizing dollar cost averaging is another method for preserving your savings amid a stock market meltdown. This is routinely investing a predetermined sum of money in the stock market, regardless of whether the market is rising or falling. Because you buy more shares when prices are low and fewer shares when prices are high, this can lessen the impact of a market crash. Say, for illustration, that each month you invest $500 in the stock market. Your $500 investment will buy you more shares than it would have if the market were up in the event that stock prices fall and the market crashes. This will eventually lessen the effect a market meltdown will have on your entire investment. Part 5. Invest in quality stocks. Concentrating on buying high-quality equities is another approach to safeguard your savings during a stock market meltdown. Stocks that have a proven track record of earnings growth, excellent financials, and a competitive advantage in their sector is considered to be quality stocks. Compared to lower quality equities, these stocks are more likely to withstand a market slump and recover sooner. For illustration, suppose you have $10,000 to invest and can choose between Stock A and Stock B. Stock A is a reputable business with a proven history of earnings growth and a competitive edge in its sector. Stock B is a more recent corporation with erratic earnings trends and a less stable financial situation. Stock A is more likely to maintain or even gain in value during a market downturn, while Stock B may see substantial losses. Part 6. Use stop-loss orders. Using stop-loss orders is another method for safeguarding your investments during a stock market crisis. An order to sell a security at a specific price is known as a stop-loss order. Automatically selling your stocks when they reach a predetermined price can assist you in limiting your losses in the event of a market meltdown. Say, for illustration, that you have $10,000 invested in the stock market and are worried about a crash in the market. A stop-loss order can be set at a price that would result in a considerable loss for you, such as 10% below the price at which you originally made the buy. Your stop-loss order will automatically sell your stocks and reduce your losses if the stock market crashes and they drop to that price. Part 7. Avoid market timing. Lastly, attempting to time the market is one of the worst blunders you can do during a stock market crash. This entails making investment decisions based on a prediction of when the market will rise or fall. Timing the market is incredibly tough and frequently leads to lost opportunities or big losses. Focusing on a long-term investing approach and letting your money increase over time is preferable to trying to time the market. Although there will be ups and downs in the stock market, in the long run, its value has a tendency to rise. You can survive short-term market crashes and emerge ahead of the game by avoiding market timing and investing for the long run. You can employ a variety of tactics, such as diversification, long-term investing, dollar cost averaging, investing in high-quality equities, employing stop-loss orders, and avoiding market timing to safeguard your savings during a stock market crisis. You can survive a stock market crisis and come out ahead if you put these tactics into practice and resist the urge to panic. We appreciate you watching this video on investment protection following the stock market meltdown. We sincerely hope this was useful. Please leave any questions or remarks in the comment below. You can also check out our website mezinance.com for more financial tips. And don't forget to like and subscribe for more financial planning tips and tricks. See you on the next one.